Good morning, everyone.
Well, good morning, Adrian.
Hi, good morning, David.
Thank you.
How are you?
Thank you for agreeing to do this fire chat.
Thank you very much.
I'm grateful. I have been hearing unit holders over the last couple of weeks, and SIAS decided to invite you this morning to have a fire chat with me, to have an honest and open discussion, Adrian, on those areas which are troubling some of the unit holders of both ESR and ALOG. We will also be having a chat with the CEO of ALOG.
Sure.
So, unit holders, this morning's exercise is a fire chat with Mr. Adrian Chui, CEO of ESR-REIT, on the merger of ESR-REIT and ARA Logistics Trust, ALOG. Now, just a few days before the EGM to vote for the proposed merger of ESR-REIT and ARA Logistics Trust, ESR revised its scheme consideration for ALOG from 0.095 to 0.097 in cash, and from 1.6765 to 1.7729 of ESR-REIT units for each ALOG unit. Now, this superior offers, I'm sure, is welcomed by ALOG unit holders, Adrian.
Yeah.
But is it, what they're asking is it really enough? And why only now? So let me ask you, the revised offer, Adrian, was made after the proxy advisor's recommendations to ALOG, right? To unit holders, to vote against the resolutions at the EGM on 27th January. Now, for the longest time now, I have not seen ISS or any proxy activists coming against a merger like this. What really made ESR-REIT therefore revise the offer? And is it enough? And why only now?
Yeah.
So you're going to talk about, I think, the rationale that led to the revision.
Yeah. Thanks, David. I think this is a very good opening for us, and this is why we want to hit straight into the point. That's great. Now, the key reason why we revise is because of potential conflicts of interest. Why is it there? This transaction, when we announced on 15th of October last year, was very clear that this merger between ESR-REIT and ALOG is conditional upon the completion of the ARA acquisition by our sponsor, ESR Cayman. Okay, we would not have looked at this merger between ALOG as well as ESR-REIT had there not been a transaction of a proposed ARA acquisition by our sponsor, ESR Cayman, which I call it as the mothership deal in short. All right.
Yes.
Had there not been a mothership deal, we would not have looked at this merger alone, because prior to that mothership deal announcement, ESR-REIT sponsor is ESR Cayman. I have my own sponsor. I have my own sponsor's pipeline. I have third-party acquisitions which my sponsor will focus on in supporting me with financial resources. ALOG's sponsor was actually Logos, which also as a standalone has its own pipeline. So we were okay. But with the announcement of and completion now of the mothership deal, the potential conflicts of ESR Cayman has become a common shareholder of both of our REITs. Okay, so there is potential conflicts of interest when it comes to asset pipeline from our sponsor, financial resources.
So if I may at this point intervene, growth of ESR-REIT and ALOG likely to be negatively impacted.
Yes, definitely.
If both REITs conflicts of interest arising from a common sponsor are not resolved. How
exactly.
do you resolve this?
Exactly. You know that, David, I mean, REIT's performance, the growth of the REIT is very much tied to the sponsor's support. How much sponsors, especially the pipeline as well as financial support, right? Now, before the mothership deal, it was very clear. There were no uncertainties about the pipeline as well as financial support. But now with a common sponsor, ALOG's sponsor and our sponsor, which is a common one, there's a conflict if we do not come together. So who, for example, which of the sponsor asset pipeline goes to which REIT? We also want to grow, they also want to grow. The sponsor has limited resources. So how much should be allocated to which REIT? So if this potential conflict of interest is, and it is real, it is not solved, it will impact the growth of our respective REITs. And this is actually very, 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 very not, it's quite detrimental to our unit holders. When there's uncertainties regards to pipeline and financial support and the sponsor support, this is where share price can be affected, and also DPU growth as well as overall. So this potential conflict of interest is no more potential. As of 20th of Jan, when the ARA acquisition was completed by our sponsor ESR Cayman, this conflict of interest has become a reality. So we have to address these conflicts of interest. If not, uncertainties will happen in the market regards to, as I mentioned,
yes,
assets, which assets go to whom, and we'll be fighting. Even for third-party assets, we will be competing against each other to fight for the asset, and we will be like outbidding each other. And who do you think will, and in the end, the unit holders will not get the best deal. Even for tenants, we will be competing for tenants and giving me unfavorable lease terms just to win the tenants, and it's not beneficial to our unit holders. So
you're saying that you are adequately addressing the conflict.
Yes, this is the real key issue. This conflict has become reality today. Now, why is it not rearing its head? It's because we are now in the offer period. Both ALOG and us have to do a standstill with regards to fundraising, regards to buying properties and all this stuff. So it's a standstill. We cannot do anything. But if the merger does not go through, right, we call it off. Then now the real conflicts start to come out. And that is a key reason why we have to do a revised offer to ALOG unit holders. Now, obviously, ISS and Glass Lewis, the proxy advisors, has mentioned certain things that, okay, the deal seems to be more favorable to ESR-REIT unit holders than ALOG unit holders. But they also missed the point that is conflict of interest. This is the biggest point that is detrimental to both sets of unit holders. And that is why we say, okay, despite the fact, okay, we take ISS, the proxy advisors, some of the points that, yes, it seems to them on their paper is that it seems to have more beneficial to ESR units. So the revised terms is such that we are able to try to shift the balance a little bit to both parties, so that we are able to get respective unit holders support to actually approve both the resolutions. And however, the revised terms cannot be too skewed to one side, such that we end up, having one side approved and the other side becomes another. So the revised term seeks to try to balance, but in the end, at the end of the day, this is actually a merger. Both parties has to come together in order to make sure that the conflicts of interest is actually addressed. Yeah,
there is a very strong view, Adrian, in the marketplace now that ESR could well afford to revise the offer to a slightly higher offer because they feel that you are going all out to acquire ALOG. You must have ALOG. And what you have offered seems to be very little at the moment. The increase offer, they say, is very little. Can you think about, or can you commit today that you will reconsider the offer?
I think we have taken into consideration what are the feedback from the market.
Yes.
Everybody will tell you the highest price. Everybody wants the highest possible price. In our view, we have to balance both sets of interests of unit holders. Do I need to acquire ALOG? Definitely. My proper answer is no, because if not for the conflict of interest I mentioned upfront, is that we have our own plans.
Yes.
ESR-REIT has our own plans in terms of pipeline from our sponsor ESR Cayman, the financial resources. If you look at financial resources, in the last 2 years, we did close to $250 million worth of, or $300 million worth of equity fundraising. Our sponsor backstopped the pref offer of up to $175 million. So you can see that I have my own plans, but because of this merger, in fact, it's not I have to acquire ALOG, or ALOG has, actually both of us has to merge, or else it's going to be detrimental.
Yes. So they must merge. It is a must do exercise.
Yes.
Can you go up a little bit more?
No, I think it's fair. I mean, if you look at where we are right now, you
Yeah.
know, and most important thing is, I think whether the price is right or wrong is also
Yes.
whether the price is enough or not enough is also a function of whether there are anybody who come in and bid. Now,
Yeah.
since 15th of October, nobody has come in to bid. You know, it's like me selling a house, right?
Correct.
I believe that my price, my house is worth 2 times more than what was the last
Okay.
you know, but if there's no bidders, then
Yeah. So perhaps you can tell your unit holders, especially ALOG unit holders, the price that you're offering is good because you feel that going along with you in marriage, they are likely to, in all sense of the word, benefit you. So tell us what are the benefits in due course.
well, the benefits are clear. You know, first thing, once you address the conflicts of interest, there is not a need for the sponsor to split the resources between two REITs. So we are, as a combined entity, combined one REIT, we are able to leverage on the sponsors' common sponsors' resources as one entity. It's all focused on us. Asset pipeline is very clear. Financial resource is very clear. And as a larger REIT, as 5.4 billion, we are definitely able to grow faster and larger. Both ESR-REIT and ALOG, prior to the mothership deal announcement in August last year, we were probably one of the most active and fastest growing REITs around. Because why? We are in the right sector. You know, the industrial sector, the logistics sector. So we are there. But now, if we come together as a 5.4 with the sponsors, focus resources, pipeline of assets, financial resources giving to this REIT, we can actually grow faster and as well as grow larger, as compared to two separate REITs who is 2 billion AUM and 3.3 billion AUM. So this is the proposition that we are selling to the unit holders. DPU is actually accretive on both sides of the REITs. In fact, ALOG unit holders has probably the highest DPU accretion with our revised terms, probably in the history of the all the precedence mergers in Singapore. I mean, I recall it's about 12.2% on a pro forma basis DPU accretion. Even NAV, they're up like I think more than 2% So this is, it allows them to crystallize in a way that the run in the share price that is already been, and you still are able to benefit from the combined resources of the large sponsor. And if you look at it, we have mentioned that the group has close to $53 billion worth of pipeline assets. Immediately, there's $2 billion worth of assets that is low-hanging fruit for us that we've identified. You know, with a larger 5.4 billion REIT, with better access to capital, better credit, lower cost of debt and funding. I think my proposition is this: a large REIT, or what we call ESR Logos REIT, or ELOG in short, will actually be able to grow faster and more accretively and even larger.
So you're assuring ESR unit holders that their DPU will not be impacted and their investments will bring better returns in the future. Okay, so can they get some guidance on this? What are you thinking of? What are you promising them?
No, I mean, it's not really a promising. I mean, our track record has spoken us ourselves. We have over the years been able to grow our REIT from I think it's 1.5B to current 3.3B, and it's all because we have a strong sponsor, ESR Cayman, who's aligned with us in terms of strategy. But at the same time, we also make sure that when we grow it responsibly, and we don't take too much risk on that. You know, I think this is a track record that a lot of our shareholders, our investors has told to us. Some of us actually told us that some of them has told us actually you're a bit slow in trying to acquire bigger. But I think we always need to, from a management perspective, we also need to manage growth as well as risk. You want a huge growth, but you also need to manage the risk appropriately. And we have been able to, over the years, importantly, bring down our cost of funding, bring down our increase our access to the funding. We have done perps, we have done bonds. Everything is much better. We even refinance our debt earlier than it would have, earlier than expiry, and even and refinance at a lower rates and longer tenor and even during a pandemic called COVID, you know. So I think for us, the numbers are there. The pro forma accretion from this transaction is about 4%, 4% DPU accretion, 4.7% DPU accretion with the revised terms. Yes, it used to be 5.8. It's come down a little bit to 4.7, but it is still accretive. I want to assure my unit holders that this transaction is not as skewed totally to one side. You know, the whatever I mentioned just now in terms of ability to write the sponsor, get the sponsor focus its resources on a single large unit REIT like us with all the acquisition pipeline, is also benefits our ESR-REIT unit holders as well. And importantly, once we have 5.4 billion, we actually have access to freehold assets and longer lease longer tenure assets, longer land tenure assets, which actually are able to address the short-term land leases of Singapore industrial assets. And now at 5.4, because we are larger, we have better, cheaper cost of funds, we are able to then acquire more and larger, longer leases and freehold assets to address and push and to address the so-called land lease decay that we have in Singapore. In fact, I have taken comments, I've taken feedback from my own ESR-REIT unit holders that why don't you look at a credit rating for the REIT? Because you have 5.4 billion. If you have a credit rating by the REIT, that means either by the S&P or the Moody's, a REIT rating, actually your access to capital will be wider, and the cost may be even lower. So actually, this is one of the feedback I get from my unit holders, and I think this is sensible. Yes. It's something that we will look into. And at 5.4 billion, the ability to go for a credit rating will be much better than
yes.
if you got 3.3. And if you got a good investment grade credit rating, I do think that the cost of capital, cost of funding will probably come down, as well as the ability to access more funding. And I think as a larger REIT, one also important thing that worries me, not as a larger REIT, I mean as a standalone right now, as a 3.3B REIT, one of the key things that we need to take into consideration is rising interest rates. I think inflation is coming. It's very clear. Inflation is coming. The rates, the Feds are already indicating, the market's already indicating what are the kind of hikes that they have. As a larger REIT, the fact that we are able to have better costs of capital and ability to manage access to wider pools of capital, it will help to mitigate the threat of rising interest rates.
Good. Another area of concern, Adrian, some of the unit holders say the merger will be dilutive to ESR-REIT on an NAV basis. Yes. I think that's a fact. Yes. Immediately there will be. Have you considered waiving the acquisition fees, they ask? I tell you why. Yes. Acquisition fee is about 15.9 million. Doing so will also improve the chances of getting ALOG unit holders buy-in, they say, since they will be accepting new ESR-REIT units. For reference, in a recent large merger of two S-REITs, the manager completely waived the acquisition fee of over 111 million. Yours is 15.9 million. So they're asking, will the manager kindly, waive the fees?
Okay, I think there is this is how we look at it, and in regards to the fee basis. You know, I mentioned very early, David, that a sponsor support is very important for the growth of the REIT, especially on the asset pipeline and financial resources.
Yes.
I've also mentioned earlier that our sponsor has demonstrated over the years on this support. For example, for ESR-REIT, we had the EALP injection into ESR-REIT last year, and that over the years, the sponsor has backstopped 175 million, taken out $175 million of its money to backstop all the fundraising, to ensure that the fundraising is done, is completed, and more importantly, help to save unit holders underwriting fees.
Right.
So this financial resource, the pipeline, is very important, because that is why the sponsor support is very important for the growth of the REIT itself. We also need to understand also is that because of this sponsor resources, and ESR Cayman themselves is a listed company, they have their own shareholders. They also need to see a return in order for them to continue to provide this support and resources. And the fees that's payable is very clear in the trust deed, and it's taken in units, and which shows a strong alignment with unit holders. The REIT, both ALOG and ESR, is not paying anything that is any extra. In fact, for ALOG side, they're not even taking a divestment fee, right? So if we believe, and I definitely believe that a sponsor support is very important for the growth of the REIT, especially when my sponsor's pipeline comprises of in-demand logistics assets. We believe that it is better off, and it's like our unit holders weren't necessarily better off if the sponsors sees that the REIT unit holders are actually, in a sense, free riding on the sponsor's resources, because they also have their own shareholders. Their own shareholders, ESR Cayman shareholders, are asking, why should we be giving people, all these free pipelines and free resources when all the assets are in demand, and in the end we still have to don't get the return for it. And my sense, that is why, to me, the focus of my unit holders is do not focus on the fees and the acquisition. The key is what is the asset pipeline and what is the financial resources that the unit holders are putting in. If you look at what ESR has provided in terms of its capital at risk to support the growth in the last 4 years, 175 million. I'm not too sure what's the fees now. It's like 15 odd over, I think, 175 versus 15. And we are expecting them to give more. and the underwriting fees that they have saved for the unit holders for the years, and to ensure that the deal has deal certainty. I think this, to me, all these resources, support and all, is much more worth than the acquisition fees that we are talking about. And importantly, the assets and the pipeline of our sponsor is actually in demand right now. I want that pipeline, and that's important,
You made a very strong case why acquisition fee of 15.9 million has to stay in the interest of
I just think that we should see the things in totality, not just as a standalone.
Yes.
Over the years, and more importantly, going forward, and especially in a sector where the assets are really in demand, the so-called new economy assets and all, the logistics assets, the data, the high specs building assets, the data center assets that my sponsor have, we want that, and if one day the ESR Cayman shareholders decide to say, hey guys, we are providing all these resources, but we got to the REIT, which we only own, I think post-merger probably add together probably about 13-14%, but we're giving all the resources, all the pipeline, and put our capital at risk to support their fundraising, I don't not getting a return. Why should we? So you don't want that to happen, right?
So let me take you to another area of concern. And both ESR-REIT and ALOG have emphasized that the future is in the new economy assets.
Yes.
But the non-new economy assets of ESR-REIT would be a concern to ALOG unit holders. If the merger is on, can you share how this merger will work, especially on the plans for the new economy assets? Will the portfolio rejuvenation be costly now that the market knows that you are repositioning the REIT?
Oh, yeah. Okay, so post the merger, the unit economy assets, which actually comprises both high specs and logistics assets, will make up about 66% of the portfolio. Now, new economy doesn't just mean logistics assets, general industrial space that can be converted to high specs space. And this high spec space are used to capture advanced manufacturing tenants, pharmaceutical companies, data center operators, and all the other tech firms. So this allows us then to write the industrial 4.0. Now, those assets that is small footprint, we cannot redevelop, we cannot convert, we're going to sell. And we are not asset hoarders. I have shown the last 2 years, 3 years that we've been selling close to $80 to $90 million worth of smallish assets. We'll continue to sell them, because if we manage some of these, continue to take some of these assets on the books, assets like $7 million worth, $20 million worth, it takes up our resources and the time. And we won't just hold on to these assets for the sake of earning a funds management fee. We are not asset hoarders. So an important thing is that, as always, a cycle. Unit holders could remember that 10 years ago, or during a certain cycle, logistics wasn't the in thing. We know that logistics is going to be new economy assets, it's going to be sustainable, but it also means that there are also sometimes cycles, because industrial assets, industrial revolution changes, asset users changes. The key is to stay relevant. As the high specs property, some of the general industrial business can be converted into high specs, and we have been doing it. 30 Marsiling was done in 2018. We are now doing 19 Tai Seng. We are doing 16 Tai Seng again, and we have 7,000 Ang Mo Kio building up new buildings. So this is essentially what the fund managers like us that we need to do. You always look at the trends that's coming. You position your portfolio by asset rejuvenation to ensure one thing, that your asset stays relevant. Right now, is it going to be costly? I think in the short term, there might be a little bit costly first, and that is why after the merger we have to sit down and we've got to pace the new economy assets. I can share with you that prior to, and I told this to all my investors 2 years ago, I have a lot of people, especially data center operators, coming to me and telling me that they want to buy my asset, because especially the older asset, because they want to convert to data centers.
Right.
All right. That was before the JTC moratorium. Now, and the best part is this: when they come and see me, they actually done their homework and they tell me which are the assets that I want, that they want to buy. And we obviously know which are the assets that can be converted to data center. Then obviously the moratorium from JTC moratorium came in. No, but it had just been JTC has sort of lifted with certain conditions. Now all these guys are coming back to me again. Right. And asking me, now can we look at it again? Can we also now rent your high specs building, because we have data center operators, all this stuff. So right. So these are some of the so-called assets that can be converted, and it all goes down to the same line of thinking that we have to make our assets relevant to the industrialists. Now, we may need to relook post the merger. We will probably need to sit down a little bit to say how fast and how much to do. It's because cost is rising, construction costs and all the other costs has increased quite a fair bit. But the point I'm trying to make is that in the short term, we may slow down a little bit on the conversion, because the cost that is rising so fast, rising quite inflationary pressures due to construction costs, may eat into the kind of returns that we are getting. Now, somebody tells me, Adrian, so I'll give you an example. I used to be able to do all these asset enhancements having a yield on cost of about 9 to 10%. Today, if I want to do the same thing, it will probably be 7 to 8%, down by about 20-25%, because costs have gone up 20-25%, construction costs, labor costs, and all this. But the point is, then somebody say, but Adrian is still 7 to 8%, so why don't you do it higher than your WACC? I say, yeah, but 7 to 8% for the risk that I'm taking in terms of shutting it down, losing income, time for construction period has been delayed because not enough labor. 7 to 8% may not be enough, so I want to slow it down, take a recap, all right, and before we undertake some of this EM. But my point is that there are enough assets from the so-called old economy that can be converted to new economy. It's not going to be, if those assets cannot be converted, I will sell.
So you're quite confident of integrating the proven record.
Yeah, we have.
And expertise of logos in logistics in the enlarged entity.
Oh, of course. What is going to happen is that, Logos has the specialization, has the skill set. We have our skill set as well. Now, the Logos team will join us. We're already one family. As I said, the mothership deal is done. We're actually one family already.
Is Karen going to be your deputy?
Yeah. We will. Yeah, definitely. Yes. That is why we made. I mean, we just made the announcement of the two. But yes. the truth of the matter is, bulk of the team will be together with us. We are managing a REIT that has diversified, still has industrials, has high specs, has logistics. So it is what we are going to do. So that in the integration of it is we have the experience. We did the Viva merger 2 years ago, where it was a smooth merger. And actually, the fact is that the integration of people always thought the integration is always a big problem, culture. Not really, because we are in the same sector. We are in industrial, we are in logistics. They buy logistics, we buy logistics. The investment returns, the due diligences, how things will be done is very similar, right? Now, if you have a retail mall and an office coming together, yeah, I think the integration will be a bigger problem, because it's like retail mall and office are totally different things, you know.
Yeah.
But when you have two in the same
Logistics, yeah,
it is much easier. It's just as a Viva. When we deal with Viva, we was from accounting policies to something, it's very similar. You know, I would say at least 75% similar. And actually, after probably about 2 to 3 months, we more or less we are already very one already. Yeah.
So Adrian, what are your final words for ESR unit holders?
Yeah, you always come there. You know, my final words for ESR unit holders is like the downside risk from the uncertainties for not addressing the conflict of interest can actually significantly impact the REIT's growth. You know, in the absence of this merger, there are actually significant overlapping mandates between ESR-REIT as well as ALOG, actually in terms of the asset pipeline, the tenants, the operational network, and the financial resources from the sponsor. I sincerely believe that this merger is beneficial to our unit holders. We need to do this merger now and it's more critical because the ARA acquisition has been completed, and we will need to address this conflict of interest. You know, we should be removing all the uncertainties relating to this conflict of interest to our unit holders and jointly leverage our sponsors' resources as a single platform to grow faster as well as grow larger, and that the asset pipelines and the financial resources are there. I do urge our unit holders to look at the positive side of the things, because this merger will not, yes, we have revised the terms. It seems that the DPU accretion has come down, NAV dilution has increased a little bit, but this is short term. On the longer term, it addresses our underlying land lease issues. We get access to freehold assets. We have ability to access wider and cheaper funding. We have the asset pipeline that is there with the sponsors' resources that is supporting us. And we are definitely able to grow better. And we are actually in the sector that is in demand, and that the tailwind is behind us. So this merger will allow us to ride the tailwind even faster and larger.
And the unit holders stand to gain in the
yes,
long
and the
run.
unit holders definitely stands to gain from all this. Yeah.
Thank you, Adrian, for your time this morning. We have covered quite a number of areas, and we hope that the ESR-REIT unit holders are now in a position to make an informed decision.
Yes. Thank you, David. Appreciate it.
Have a good Chinese New Year.
Same to you. Thank you very much for your time.
Bye.
Thanks, everyone.
Bye.
Thank you.
Bye.
Thanks. Bye.